Well, for more on the markets, I'm now joined by Peter Andersen of Andersen Capital Management. Peter, hi, thanks for joining us. Let's start, if I may, with today's economic data. Inflation coming in higher again. What does that mean for the Fed? Does it mean they could hike again in June, do you think?
I think that there's a little bit of noise with this inflation data. So when we look at it so closely, I'm not surprised that you will see inter-month and fluctuations like that. That's the first thing. And the second thing is, remember, they started hiking in March, a year ago, March. So we're only 3 hikes into what I would call a rolling, 1-year period of these hikes manifesting themselves in the economy. So if the Fed is smart, they would look at this inflation data, but they will also say, well, we've raised so many times, and we're just really 3 hikes into this. So let's be a little bit more patient and see how the rest of these hikes play out. Time is our friend in this case, not our enemy.
And it seems the markets think this debt ceiling deal is done or almost done. But is there nevertheless a potential downside for US sovereign debt, with ratings agencies threatening to downgrade it anyway?
The only thing I can say is we've been through this 20 times in the past 20 years. And as you mentioned earlier, in 2011, there was a downgrade. That really spooked the markets. But I remember anticipating that treasuries would trade off as a result of that. And ironically, treasuries still rallied because they were still considered the flight to quality. So, of course, it's unthinkable that we would have a default. And we do worry that maybe the politics has gotten so much leading this issue that there could be a delay. And if there is a delay, it really would upset the markets. However, I would say, even if there is a delay, there will eventually be a resolution. And that might actually be a buying opportunity if the markets were to get rattled from a delay.
Is it wise, though, do you think, to stay away from treasuries, especially shorter dated treasuries right now?
I think you should only play treasuries if you like gambling right now and you have some money that you'd like to just place your bets as to what you think the resolve is going to be. Not necessarily what, but when you think the resolve is going to be. So I recommend people stay away from treasuries right now, simply because it is very, very speculative to figure out what a bunch of politicians in Washington are deciding among themselves how to resolve this. That's a very unanalyzable situation, I think.
In the equities market, Peter, our other big headline this week has been Nvidia, which of course exploded amid growing interest in AI. But how should investors be playing that market? How can you get the benefit?
AI, unlike the metaverse, unlike cryptocurrencies or cannabis, I think AI is really here to stay. And a company like Nvidia is the main player. And even though it has rallied this high, I still think there is a long runway. It's my top holding in the portfolio. I am a tremendous supporter, and I continue to think that AI will bolster the success of companies like Nvidia and several others, frankly, that are finding themselves. 2 or 3 years ago, if you asked Nvidia where were you going to be 3 years from now, I doubt they would have suggested that AI was going to be their sweet spot. But here we are, and it's a confluence of events that have happened, and now AI is really taking off. And in my opinion, we are very, very early in the AI development, so I'm quite sanguine about the outlook for the next 5 years, actually.
Peter Andersen of Andersen Capital Management, thanks so much for joining us.